With the exception of the Swiss franc, likely responding to geopolitical tension surrounding the fate of the U.S.-Iran nuclear deal, currencies were once again down against the U.S. dollar on the day. Comments from the Fed chair were also sourced as a contributor of dollar demand after Powell downplayed the impact of policy normalization on global financial markets and emerging market economies. In the end, Tuesday's dollar push resulted in a fresh 2018 low for the euro, with the major pair gravitating to the 118 barrier, though setbacks were manageable nonetheless, contained to 0.5% of daily opening levels. Declines in the yen and pound were also marginal, and though the commodity block currencies were harder hit, with Aussie down the most, setbacks there would be held to within 1% of daily opening levels. It's worth noting both Aussie and Kiwi extended their own 2018 lows against the buck on Tuesday as well. Relative weakness in the Australian dollar came from the early Thursday release of weaker Aussie retail sales. Better than expected German industrial production wasn't much of a help to the euro, also offset by risk associated with another round of Italian elections, potentially. Looking ahead, Wednesday's economic calendar is exceptionally thin, with only U.S. producer prices standing out. But the market may welcome the lighter calendar given all of the action out there at the moment, especially with things heating up on Thursday and Friday. As far as the big picture goes, the medium-term outlook remains unchanged, even with all of this dollar strength, and we believe extended technical readings are already starting to warn of a move that once again sends the US dollar lower. Since breaking down below 122, we had talked about the possibility for a euro decline into the 117s. We aren't too far off at this point, and we believe medium and longer term dollar bears will start to look to increase exposure as they bet on that soft dollar policy initiative making its way back into the spotlight. That's all for now.